An asset is said to be impaired. An asset is said to be impaired when the carrying amount, an asset is said to be impaired when the carrying amount exceeds recoverable amount. An asset is said to be impaired when the carrying amount exceeds recoverable amount. When the carrying amount exceeds the recoverable amount. And you see that? Recoverable amount is the higher of recoverable amount is the higher of, saying that recoverable amount is the higher of A, fair value less cost to sell, and B, value in use. The recoverable amount is the higher of A, fair value less cost to sell, and the value in use. So now let's explain that value in use. Explain the value in use. See that? This is the present value. This is the present value. This is the present value of the future cash flow. This is the present value of the future cash flow from the assets, from the asset remaining service potential, from the asset remaining service potential is the present value of the future cash flow of the asset or the remaining future service potential, or for the remaining service potential, for the remaining service potential. Good. Terminologies. Terminologies. Number one, cash generating assets. Cash generating assets. So that this is an asset held. This is an asset held with a primary objective of generating returns, with a primary objective of generating returns, the primary objective of generating returns. The primary objective of generating returns. Number two, cash generating unit, CGU, cash generating unit. CGU, where to see that? This is a group of identifiable assets. This is a group of identifiable assets held with an objective, of generating commercial return, held with an objective of generating commercial returns. Held with an objective, with the primary objective of generating returns. Number three, non-cash generating assets. Non-cash generating assets. You see that? This is an asset. This is an asset. This is an asset other than cash generating asset. This is an asset. This is an asset other than cash generating asset. Cash generating asset other than the cash generating asset. So now I was explaining something about the impairment. Now we are saying that an asset is said to be impaired when the carrying amount exceeds the amount, when the carrying amount exceeds the recoverable amount. Yes, the cost to sell. Now that's what we call the net realizable value. The net realizable value, you compare against the value in use. Now, what's the value in use? Now, value in use, you're saying that in case you don't want to sell this asset now, how much cash flow do you generate in the future? Value. Now, that's what you call value in use. The present value of the future cash flow expected from service potential. Now, what's the difference between depreciation and impairment? Because as per the there are also value of an asset. It's only that for depreciation, is there also value as a result of usage? But impairment is due to other factors. Good. Then we have defined about the cash generating assets. What's a cash generating asset? And we're saying that this is an asset held with a primary objective of generating returns. This was a return generating. And then a CGU is a group of assets. Now, for example, to make this pen, you don't require one machine. You require a series of machines. The one for the cup, the one for the ink, all that. So that means all those machines work to produce the same product. Now that's what we call now a cash generating unit. It's a group of assets. And then lastly, we have the non-cash generating asset. Now, non-cash generating asset, you see that as per the definition, is an asset other than the cash generating asset. An asset other than the cash generating asset. So in bracket, if you want to understand this, write in bracket government assets. Government assets. They are government assets. Good. And you're saying that, how do you recognize an impairment? You ready to see that? Another paragraph. See that? Impairment loss of an asset, impairment loss of an asset, impairment loss of an asset will be recognized immediately to the P&L, will be recognized immediately to the P&L as an expense, will be recognized immediately to the P&L as an expense, Full stop. NB. Impairment of a CGU, impairment of a CGU. Remember, it's that CGU is the cash generating unit. When you have a group of assets, impairment of a CGU will be allocated as follows. Impairment of a CGU will be allocated as follows. A. First, write off the carrying amount. First, write off the carrying amount of any goodwill. First, write off the carrying amount of the goodwill. You write off the carrying amount of the goodwill. And then number B, allocate the balance of the impairment loss. Allocate the balance of the impairment loss. Allocate the balance of the impairment loss to other assets in the CGU, to other assets in the CGU in proportion of their carrying amount, in proportion to their carrying amount, in proportion to their carrying amount, in proportion to their carrying amount. Yeah, so in case of a CGU, that's how you determine, you allocate the impairment. And you think that an impairment, you'll be comparing now the carrying amount. I didn't know what the carrying amount, the amount recognized in the financial statement after taking into consideration the depreciation or amortization. Then you compare against the recoverable amount. Assume that an entity purchased an item of plant and equipment at the beginning of the year worth 4 million. And then during the end of the year, they charged a depreciation of maybe 500,000. So that means carrying amount or the net book value, that's the amount now to be shown in the financial statement at the end of the year, will be 4 million, the cost. Then you minus depreciation of 500 to get 3.5. Now, this is the carrying amount at the reporting date. Now, let's assume that the company now wants to have this asset as what we call held for sale. They want to sell this asset now. But you see, the carrying amount is how much? 3.5. But in reality, in the market, the value for this asset has reduced. The maximum they can fetch from the market, the current value, let's assume it's only 3.2 million. The carrying amount is this after taking into consideration the depreciation, but the maximum they can fetch is 3.2. So that means there is a loss of value. By how much? Now, this 300 is what we call an impairment. Good. So impairment is due to other factors, not necessarily as a result of usage. Now, for example, let's assume if you buy a new phone today worth 50,000 today, can you sell it tomorrow at 50,000? Good. Now, what do you call that? That's what we call the impairment. There is loss of value, but you see you have not used the asset. So that means the asset has not depreciated. Good. So now let's look at indicators of impairment loss. Indicators of impairment loss. Indicators of impairment loss. Yeah, when assessing for impairment or impairment test, how do you recognize that this asset might be impaired? Let's start with external indicators. External indicators. Looking at indicators of impairment loss, we start with external indicators. Number one, reduction in market value. Reduction in market value of the asset. Reduction in the market value of the asset. Reduction in the market value of the asset. Yeah, when the prevailing market is of the similar assets has been reducing. Number two. Significant changes with adverse effect. Significant changes with adverse effect. The entity's asset. Significant changes with adverse on the entity's asset, e.g., technological advancement, change of market, change of market, change in registration, change in registration, change in registration. Those are the rules of the RAND, changes in registration. Number three, increase in the market interest rate, increase in the market interest rate, increase in the market interest rate, and those rates will affect, the discounting rate. Those rates will affect the discounting rate used to determine the value in use. Used to determine the value in use. Used to determine the value in use. Yeah, those are the three major external indicators. Number one is the reduction in the market value of similar assets. Number two is when there is significant changes with adverse effect. Adverse means negative. The changes that affect your asset negatively. You buy an asset, then after 2 weeks, you hear that there is another improved or another advanced asset. So what will happen? If you have to buy a new one, will you buy the old model? No. So that means if there is technological advancement, your asset automatically will be impaired. Then number three, we are saying that is the increase in the market interest rate. How does the interest rate affect the impairment? Now you're saying that, can you go back to the definition of value in use? What is value in use? We say that is the present value of the, now let's be here. Now let's assume of this machine, you expect it will generate 4 million, or let's work with 10 million. 10 million in 2 years' time. This is what you expect this machine to generate in the next 2 years, or in years' time. And assume that the discounting rate of the interest rate is 10%. Then you also consider the same thing when the interest rate now increases to 15%. You receive the same amount. I want to show how the interest rate affects, because the interest rate will affect the discounting rate. So when determining the present value, you need the discounting rate. Now, if you use 10%, and you're saying that the value in use is the present value, if you have to receive 10 million in 2 years' time from this asset, how much will be the present value of 10%? This is 0.991. You can just take 1 plus r raised power negative n, which is 1 plus 0.15, sorry, 1 raised power negative 1. Do you get that? This is a FAR. It's not in your tables. This one use a calculator. You don't have the discounting table. Do you get 0.991? Good. So that means the present value will be 9,091,000. What if now the rate increases to 15? And now give me 15 at 15%. Let's work with only the first year. Let's work with the first year. Year one will be how much? 0.869. So that means the present value will be 8690. So what has happened? When the rate increases, what has happened to the present value? Yes, it has reduced. So that's why you're saying that whenever the interest rate increases, the value in use of the asset will reduce. Now let's look at internal indicators. Internal indicators. Internal indicators. Internal indicators. Number one, physical damage of the asset. Physical damage. Physical damage. Physical damage of the asset. Physical damage of the asset. Number two, evidence of inferior performance. Evidence of inferior performance. Evidence of inferior performance. Yeah, it's not performing the way you expected. Yeah, those are some of the indicators of impairment loss. Now let's look at something else. Impairment reversal. Impairment reversal. Impairment reversal. Impairment reversal. Let me see that. Reversal of an impairment loss, reversal of an impairment loss, a reversal of an impairment loss shall be recognized immediately to P&L, shall be recognized immediately, shall be recognized immediately to P&L as an income, as an income, as an income. Yeah, this where the asset you had recognized, previously you had recognized an impairment loss, but over time, now the value of that asset starts to increase. So that's what we call now an impairment reversal. So if impairment loss recognized as an expense, a reversal, you treat it as an income. Now let's look at indicators of impairment reversal. Indicators of impairment reversal. Indicators of impairment reversal. Yeah, they are just the opposite of indicators of impairment loss. Number one, significant increase in market value of the asset. Significant increase in the market value of the asset. Number, significant changes with favorable effects. Significant changes with favorable effects to the entity's asset. Significant changes with favorable effects to the entity's asset. Number three, reduction in the market interest rate. 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 Another one, evidence of internal superior performance. Superior performance. Yeah, that means the asset is performing better than what you expected. Yeah, those are some of the indicators of impairment reversal. Now let's look at limits. Limits of the impairment reversal. Limit of the impairment reversal. Yeah, how can you differentiate between a revaluation and impairment reversal? Limit of impairment reversal. You see that? The increased amount of an asset, the increased amount of an asset, the increased amount of an asset, other than goodwill, the increased amount of an asset, other than goodwill, attributable to a reversal, attributable to a reversal, attributable to a reversal of an impairment loss, attributable to a reversal of an impairment loss, attributable to a reversal of an impairment loss, shall not exceed the carrying amount, shall not exceed the carrying amount, shall not exceed the carrying amount that would have been determined, should not exceed the carrying amount that would have been determined had no impairment loss, that would have been determined had no impairment loss, had no impairment loss recognized, had no impairment loss recognized in prior years, had no impairment loss recognized for the assets in prior years. Full stop. Then I to see that. Any increase in the carrying amount, any increase in the carrying amount of an asset, any increase in the carrying amount of an asset beyond the initial carrying amount, 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 will be recognized as a revaluation, will be recognized as a revaluation, will be recognized as a revaluation, will be recognized as a revaluation. Now, can you go through that statement again? Go through that statement again for you to understand. So let's do an illustration. Handout question, page 1. Question 1, we are told that ABC Limited owns a manufacturing plant with a carrying amount of 74,90,000. The government has just imposed an export quota on the product manufactured by the product. Following this development, ABC Limited has prepared the following estimates of cash flow from the usage of the plant over the next 5 years. So we have year 1 to year 5. We have the cash flows. Then we have the present value interest factor at 15%. The plant can be sold. The plant can be sold currently for 5.6, can be sold currently. So that means is that what you call the fair value or the market value. The plant can be sold currently for 5.6 million. Selling cost would amount to 100,000. Cost of capital is 15% required. The recoverable amount of the plant, recoverable amount. So how do we get the recoverable amount? Now we say that recoverable amount is the higher of. Number 1, the fair value less cost to sell and the value in use. And we have the fair value less cost to sell. The last paragraph here to that. The plant is sold currently at 5.6. So that's the market value of the fair value. Selling cost would amount to 100. So you'll sell it at 5.6 then you less cost to sell. You incur 100 to get the buyer. That means the net realizable value will be 5.5 million. So you compare the value of selling it now against the present value of not selling now, but use the asset for the remaining service potential. That's what called the value in use. And they say that the value in use is the present value of the future cash flow expected from the asset on the service potential. And you're given that information. ABC Limited has prepared the following estimates of the cash flow from the usage of the plant over the next 5 years. If we don't sell it now, these are the benefits we expect. So we compare that. So to get the value in use, we discount the cash flows. So year one, generate 2.3 million. And then you discount present value interest factor at 15%. And you are given the discounting factor 0.8696. There we have is 7561, 6572, 5717, 4972. Now let's get the present value. First one is 2,000. This one is 1595. Sorry? 10 that's 2. Sorry? 595. 1155. No, right? 50. Now write that data too. Is the 80. So now let's get the recoverable amount. You see that recoverable amount is the higher of the fair value less cost to sell and the value in use. So what will be our recoverable amount? 63.80. Yeah, the maximum you can recover is 63.80. So automatically that asset is impaired. How is it impaired? Number 2 of the question. Impairment loss of the plant. Now we say that an asset is said to be impaired if the carrying amount exceeds the recoverable amount. So how much is the carrying amount? Yeah, the carrying amount or the amount shown in the financial statement, it's 74. Yeah, this should be its value. But the maximum we can fetch from the market, it's only 63, which is less than the carrying amount. So that means the asset has been impaired. So recoverable amount, we can only get 63.80. That means we have an impairment loss. Z11, that's 1110, right? Yeah, very good. So you need to recognize this now to the income statement as an expense. Now, how much will you show now to the balance sheet after impairment test? So the new carrying amount, now to be recognized in the financial statement, you'll take the carrying amount was 74.90. Then you recognize the impairment loss of 11.10. That means you recognize the recoverable amount, an amount of 63.8. Good. Let's do question number 2. No, you can copy. It's time for prayers. Let's do question number 2. Q Limited has 3 operations based in 3 countries, each of which represent a cash generating asset. On purchase, the rate of country were allocation of the purchase price of 6 million, of which the fair value of identifiable assets was 4 million, goodwill 2 million. Identifiable, that's the same as tangible asset. Identifiable asset, the value was 4 million, then there was goodwill 2 million, and if you add the total, you get 6. Now that's the cost. We read again. Q Limited has 3 operations based on 3 countries, each of which represent a cash generating asset. On purchase, the rate of country A were allocation of the purchase price of 6 million, of which the fair value of identifiable asset was 4 million, goodwill 2 million. Now that's what we call a CGU. You have more than one asset. Depreciation is charged on a certain basis over 20 years with no residual value. At the beginning of year 4, so that means we are assessing for impairment test after 4 years. At the beginning of year 4, there had no impairment of the goodwill arising on acquisition. So the goodwill has not yet been impaired. At the end of year 4, so now before we proceed, how much is the carrying amount? We are assessing this impairment after how many years? After 4 years. That's what we told that at the end of year 4. So at the end of year 4, we raise the depreciation. Now, for the goodwill, no impairment has been reported. Identifiable asset, how much was the economic life? 20. So you'll take 4 million, you divide by 20, then we are assessing after 4 years. So we want to determine how much is the accumulated depreciation. 200 times 4, that's 800, right? Good. So how much will be our carrying amount at the assessment date? So it's 4 minus 8, you get 3.2. And then goodwill was not impaired. So that means it will be 2. And the total will be 52. So I told that at the end of year 4, the government export restriction was introduced. The fair value less cost to sell, for the operation of country A cannot be estimated since a buyer could not be found. The value in use is calculated at 2.73. So how much is the recoverable amount? Recoverable amount is the higher of. Number 1 is the fair value less cost to sell and the value in use. And you are given both of them. You are told that the fair value less cost to sell for the operation of country A cannot be estimated since the buyer could not be found. So how much is the fair value less cost to sell? Is how much? Only 0. If a buyer could not be found, that means you cannot sell. If you cannot sell, what do you get? Sini 0. Hiyo ni Kiingereza tu, hakuna mahali utaambiwa ati figures is 0. So that's what you are told. You are told that the fair value less cost to sell in the operation of country cannot be estimated since a buyer could not be found. So if you cannot get a buyer, that means you cannot sell. If you cannot sell, you recover nothing from the market. But we are told that if you use, the value in use is calculated at 2.73 M. So the recoverable amount is the higher of. So how much will be the recoverable amount? 27? Required. Calculate the impairment loss and state how it should be allocated to the assets of country A. Calculate the impairment loss. So for you to determine the impairment loss, you compare the carrying amount against the recoverable amount. How much is the carrying amount? It's not there, it's here. It's an amount. This is what we are computing. So we are assessing after 4 years. Carrying amount is the amount shown in the financial statement, the net book value, after deducting for depreciation, of which the total was 5.2. Then you compare against the recoverable amount, which is 27. 30. Yeah, and that's how you get the impairment loss. That is 24. Yeah, 2470. So recognize it immediately to the income statement as an expense. But the question was required. You calculate the impairment loss and state how it should be allocated to the asset. How it should be allocated. Now, this is not as cash generating asset. This is a cash generating unit because we have more than one asset. In case of more than one asset, how do we do the allocation? So, allocate of impairment loss. So we have the assets. One is the identifiable asset, and then we have the goodwill. We have carrying amount of the carrying amount. Identifiable asset was an amount of 3.2, goodwill 2, and the total was 52. Then we allocate now the impairment loss. So that now we determine our new carrying amount. So the impairment loss is 2470. 2470. Go back to your notes. Go back to your notes. There is something you indicated about allocation of impairment loss of a CGU. Let's go back where you had terminologies. After terminology number 3, the non-cash generating asset. There is something you wrote about allocation of impairment loss of a CGU. And you see that in case of an impairment loss of a CGU, allocation will be done as follows. Number 1 was what? First of all, you write off the carrying amount of the goodwill. So in this case, first of all, we write off the goodwill. So the goodwill carrying amount was 2,000. You write it off. The next one, you allocate the balance to the other assets of the CGU in the proportion to their carrying amount. So in this case, the total impairment loss was 2470. First of all, we have allocated the 2 to write off the goodwill. So how much we now allocate to other identifiable assets? 470, correct. The carrying amount 2, that is 0. That 2 minus 470, you get 27, that, right? Can you confirm that? Is that 2730? So that means the amount to be shown in the financial statement now will be 2730. This is what I mean. The carrying amount was 52. Then you recognize an impairment loss of 2470. Now, can you take 5200? 5200. You minus impairment loss for the year 2470. Do you go back to 2730? Yes, good. You can copy now. And then when a student requests for the notes on the group, if you know your handwriting is well, kind of be screenshotting. Help one another. Yeah, because don't expect for me to share the notes. For me, nowadays I don't share the notes because the note I dictate in class, kila kitu inatoka kwa kichwa. So I don't use the other one. Hizo zingine hata ni za kitambo. So if I don't share, pende msikasirikie mwalimu. So help each other. Sorry? Rating yako. Yeah, yours is okay. Someone is requesting that I repeat on the process of allocation. Where did I get 470? Now listen here, for those who never listened. Now the impairment loss was to 2470. Now we said that when allocating the impairment loss for a CGU, first of all, write off any goodwill. You write off any goodwill. So in this case, our total impairment loss was 2470. First of all, you write off the goodwill. The goodwill, the value was 2 million. So you write it off the 2 million. Then for the balance, you allocate to the other assets. So in this case, the balance is 470. So I've taken the total 2470. You minus the one for the goodwill for you to get 470. Don't worry, I'll do another illustration. You'll understand better. August 2022, question 2A. B Limited operates a factory as its sole cash generating unit. During the year ended 30th of April 2022, there was an explosion in the factory which necessitated an impairment review. The carrying amount of the factory assets are as follows. So we have goodwill, we have patents, we have machinery, we have computer equipment, and we have premises. We are given the carrying amount, it's 47,600. Additional information. An impairment review revealed a net selling price of 19.2 million and a value in use of that 1.2 for the factory. Give me the recoverable amount. You get? Yes. We say that the recoverable amount is the higher of fair value less cost to sell, of which in this case you are given the net, revealed a net selling price. That's what we call the fair value less cost to sell of 19.2 million and value in use of that 1.2. So take the higher of the two. So therefore the recoverable amount will be, that 1.2. So the carrying amount is more than the recoverable amount. So that means there was impairment loss. An amount of, you get 16,400. Number two, half of the machinery have been destroyed and have no salvage value. So that means you write it off. 3, patents have been superseded and are now considered worthless. If they are worthless, you write them off. The company follows the cost model as permitted by IAS 16 PPE. Required. Discuss with suitable calculation how any impairment loss in the cash generating unit would be accounted for in accordance with IAS 36 impairment loss, and you get 10 marks. The question is asking about allocation of impairment. How do you account for any impairment loss? This is a CGU. We have more than one asset. So how do you account for that? That's all about allocation. Allocation of an impairment loss. So we have the assets. And for the assets, we have goodwill. We have patent. We have machinery. For the machinery, we have fully destroyed. We have others. We have the computer equipment. Then we have the premises. Then we have their carrying amount. patent 36. Machinery is 4 million. Note number 2. Half of the machinery have been destroyed and have no resale value. So how is how much? 2,000. That means the other half will be under other machinery. Then we have computer equipment. And then we have premises. And the total is 47,600. Then we allocate the impairment loss. So that now we get the new carrying amount now to be recognized in the financial statement after impairment test. Now, the total impairment loss we had was 16. Right? Now let's follow the steps. We say that in case of a CGU, how do you allocate the impairment loss? First, write off the goodwill. So how much is our goodwill? 2. So that means you write it off so that the value will be 0. Note number 3. The patent have been superseded and are now considered what? Worthless. If they are worthless, that means you write them off, right? So that you get a value of half of the machinery were fully destroyed. No salvage value. That means you write them off. An amount of? You get a balance of? So how much is the balance? Balance of impairment loss. You take 16,400, you minus 2, you minus 36, you minus 2. That's 4, 5, 6, 7. That's 88, right? Then how do you allocate this? Let's go to step number 2. Once you write off any amount of goodwill, you allocate the balance of the impairment loss to the other assets in the CGU into the proportion to their what? In the proportion to the carrying amount. So now we have a balance of 88. So we allocate this 88 to the other assets of the CGU in the proportion to their carrying amount. So we do allocation. Now here we have machinery. Machinery, the value is 2. And then we have computer equipment, 8. That's 10. Then we have premises, 30. 30 plus 10, you get 40. You get the proportion. This one will be 2,000. You divide by 40,000. Then we are allocating 8. So for 40, this is 8. You divide by 40,000. You multiply by 88. That's for 40 times 4. 17, 16. This is 30 over 40. That's the quarter. 30 over 40 times 8. The quarter of that is how much? 66. So to other machinery, allocate for 40, 1760, and this is 66. Now give me the new carrying amount. This one will be 1560. This one will be, is it 6240? What about this? This one will be 23,400, right? Add the total. Is that one 200? Good. That's what you're supposed to allocate. You can copy. Now let's look at government assets. Now let's start with the government business enterprise, GBE. Right, we say that. GBE includes both trading enterprises. GBE includes both trading enterprises such as utilities, includes both trading enterprises such as utility and financial enterprises financial enterprises such as financial institutions, And that's what we call a GBE. And mostly they are the government entities, such as KEMSA, NHIF, NSSF, Kenya Power, KRA, hizo zote. Now let's look at characteristics of a GBE. Characteristics of GBE. So what are some of the characteristics of a government business enterprise? Number one, it's an entity with the power to contract on its own name. It's an entity with the power to contract on its own name, If you enter into contract with KEMSA, yeah, the other one will sign the contract, not the government of Kenya, but the KEMSA itself. Number two, has been assigned financial and operational authority, financial and operational authority, to carry on a business, Number three, sells goods and services in the normal course. Sells goods and services in the normal course. Another one, they are controlled by the public sector. They're controlled by the public sector. Good. And that's what you call a GBE. Now let's look at GGS. That's what you call the general government sector, GGS. Yes, right to say that. This comprises of all organizational entities. This comprises of all organizational entities. This comprises of all organizational entities of the general government, in bracket, both the national and the county government, both national and county government, both national and county government, close the bracket, both the national and the county government, as defined in statistical basis, as defined in statistical basis of financial reporting, as defined in statistical basis of financial reporting. Yeah. Now, what's the difference between a GBE and a GGS? Now, you think that a GBS, you have said that is a government agency or an entity. Yeah, for example, you have said CASNEP, it's also part of a GBE. What about GGS? Now, when you talk about the GGS, we are talking about a ministry itself. This one is a ministry. This one is just as an entity. Good. Now, let's look at disclosure requirement. Disclosure requirement in respect to GGS. Disclosure requirement in respect to GGS. In respect to GGS. In respect to GGS. Yeah, that means when reporting, actually they are reported to the National Assembly. And what are some of the information? Now, for example, assuming that you are CS, mostly they are reported by the CS. Assuming you are CS of education. So what are some of the information you need to include in your report? And that's what we call the disclosure requirement in regard to GGS. Number one, revenue by major class, revenue by major class, revenue by major class. Yeah, that means you need to determine the operating revenue and operating revenue. Number two, expenses by major class, expenses by major class, expenses by major class. Number three, assets by major class, assets by major class. Yeah, that means you need to show the non-current assets and the current assets. Another one, liabilities by major class, liabilities by major class. Another one, net asset stroke equity, net asset stroke equity, net asset stroke equity. Another one, reserves. Another one, cash flows from operating activities, cash flows from operating activities, cash flows from operating activities. Another one, cash flows from investing activities, cash flows from investing activities. Last three, cash flow from financing activities, cash flows from financing activities. In short, what we have listed are the major content of the major financial statement. To the income statement, we have the revenue and the expenses. To the balance sheet, we have 4 items: assets, liability, then there are reserves and the net asset. And then we have gone to the statement of changes in equity. That's why you have shown the equity, as well as to the cash flow. Cash flow, remember, is classified into 3. Cash flow from operating, investing, and financing. Those are some of the disclosure requirements. We look at something else. Approaches used to determine the value in use. Approaches used to determine the value in use and impairment loss under IPSAS. Value in use and impairment loss under IPSAS. So which are some of the methods we can use to assess the impairment test or impairment loss or reversal of a government asset? Number one, depreciated replacement cost. Depreciated replacement cost approach. Number two, we have the restoration cost approach. Then number three, we have service unit approach. Service unit approach. Let's start with the first one. A depreciated replacement cost approach. Depreciated replacement cost approach. Let me say that. Under this method, comma, the present value of the remaining service potential under this method, comma, the present value of the remaining service potential, the present value of the remaining service potential of an asset, will be determined as depreciated, as depreciated replacement cost. Will be determined as depreciated replacement cost as follows. So if you use that method, this I will determine. So you'll take the cost of the asset, then you raise depreciation, and if you take the cost minus depreciation, you get the net book value, which will be your carrying amount. This will be your carrying amount. Then how do you determine the recoverable amount? To get the recoverable amount, you take the replacement cost. Then you depreciate. You raise depreciation. And what you get here will be our recoverable amount. So to get the impairment loss, you take A minus B. What do you think? December 2013, question 5A. Let's start with part B of the question. Part B, I told that International Public Sector Accounting Standard IPSAS 22, disclosure of financial information about the general government sector, defines a general government sector as comprising all organizational entity of the general government as defined in statistical basis of financial reporting. With regard to this standard, outline 8 items that should be disclosed in respect of a GGS. 8 marks. Which are those items? Correct. Number A. Hiyo ni rahisi, eh? But I hope you remember that in an exam. You know, maybe you might be remembering because I just mentioned some few minutes ago. Then if I ask you the same question in our next session, that's actually what was GGS. What's the difference between a GGS and GBE? GGS and GBE. You know what you write is not that important than what I say using my mouth. Yeah, for those students who are good in listening, they get it better than those who write. We have some people who love writing. Kuandika tu. Na Kenya wanaandika sometime hawajuangi. That's why I aggregate always. First of all, listen. Once you understand, you copy. Sasa kuna mtu anaandika, then anaelewa baadaye. Yeah. Part A of the question. In 1993, the Nairobi County government constructed a public primary school at a cost of 25 million. So the cost of the school was 25 million. It was estimated that the school would be used for 40 years. That's the economic life. By the end of 2013, that's after how many years? From 1993 to 2013, how many years? 20. So that means we are assessing for impairment after 20 years. Now let's be here. We deduct the depreciation. So you'll take the cost, which is 25. The expected economic life was 40. Then you're assessing after how many years? 20. What do you get? That one don't have to use a calculator. 20 over 40, that's a half. A half of 25 is how much? How much is the carrying amount? Is it 12.5? You know, accountants should not be using calculators. Accountants. Imagine when unatambuliwa wewe ni accountant, mathematician, na kila kitu hata 3 plus 10, you have to use a calculator. 30% of 50 ni ngapi? That percent of 50 ni ngapi? 16. Oh. Well, I thought accountant should be good when it comes to numbers. Ama kujua namba ni show off. Anyway. Good. We proceed. By the end of 2013, the school population had declined from 1,500 students to 400 students as a result of population shift caused by bankruptcy of a major employer in the area. Do you understand that scenario? No. Tusome tena. By the end of 2013, the school population had declined from 1,500 students to 400 students as a result of population shift caused by the bankruptcy of a major employer in the area. Now you understand what it means, eh? Yeah, that's what will happen in Naivasha if the Kerosha is closed. True or false? Kerosha employs how many people? You hata hamjui. It's one of the big liquor firms, a firm that pays, that's supposed to pay over 3 billion tax in a year. So we expect their revenue to be too high, right? Mm-hmm. So that means you expect them to employ more than 600 people. Mm-hmm. So when it's crossed, what will happen to the 600 people? Now, the 600 people, they also have dependents, right? We have a parent there with 3 kids and a wife. Those are 4. Another in the family. So what will happen? 600 jobs, not just 600 because they have suppliers. Watakula wapi? Mama uji mwenye anapeleka chakula ataenda wapi? Siana nyumbani. Due to failure to pay the tax. But I think that's not the good strategy we should use. Because now if you close the business, how will you cover that? You know, you want to close that, you sell the asset, you recover your tax after that. Si employers walikuwa nalipa tax. Wakilipa mshahara, even if they don't pay directly, they contribute to our economy. And that's how we are killing our economy, because you see, as I usually say that in tax havens, they encourage investors. Here we are killing investors by high taxes. Yeah, because if you look at tax rate in Kenya is 30%, right? What about for non-resident company? That's 7 point, but that one is to be reviewed, right? That's 7.5. Now, if you consider coming, assuming you are an investor, assuming you are a billionaire, you are just assuming, Then you have an option of investing in Kenya, you'll be paying a tax of that 7.5, and going to Mauritius, which is a tax haven. You're given a tax holiday of 20 years, no paying taxes. While construct the industry, the government will construct the infrastructure, barabara mpaka hapo. Why would you go? Mauritius. Since you are a billionaire, you know billionaire associated with billionaires, right? Ataenda kuita marafiki zake, kuja twende Mauritius. Kuna good job opportunities. Now, if I invest 3 billion in Mauritius, will I come with my employees from where I came from? No, I replace the locals, right? But here is the opposite. What should we do? But I think that's due to personal interest. Because that thing is bigger than what you see. Anyway, we are discussing about this. So we are told that by the end of 2013, the school population had declined from 1,500 students to 400 students as a result of population shift caused by the bankruptcy of a major employer in the area. The management decided to close the top 2 floors of the 3-story school building. The management has no expectation that enrollment will increase in the future, such that the upper story would be reopened. The current replacement cost of the school is estimated at 13. The replacement cost, it will be 13. Now listen here. Now, when determining the depreciation of this depreciated cost, we assume the same terms here. 13, we assume the same economic life for 40, then we assume we are assessing after also 20 years. Should be here now. So it's 13 over 40 times 20. You get 6.5. So how much will be the recoverable amount? 6.5. You got it. Now give me the impairment loss. A minus B, you get 6. Good. Required. Calculate the impairment loss to be recognized using the depreciated replacement cost. Get that. Now let's do another one. December 2014, question 5. Let's start with question 5A. 5A. With reference to IPSAS 26, impairment of non-cash generating asset. 1. Explain the meaning of the cash generating assets. What's a cash generating asset? Is an asset held with a primary objective of generating commercial return? As simple as that. Number 2, analyze the criteria that could be used to identify an impairment that might be impaired. Identify an asset that might be impaired. 8 marks. Criteria of identifying that an asset has been impaired. Don't overthink, eh? It's very simple. Mmeelewa swali? Hamjaelewa. Okay, what are the indicators of impairment, Rose? Good. Sasa, this is what I find in an exam. Swali itauliza hivyo umeuliza, ukose kuelewa. But it's something that you know. You see, they have not indicated that indicators of impairment, Rose. They have just said the criteria to identify that an asset might be impaired, which is simply indicators of impairment. Yes. You fail to interpret the question, you fail. Yeah. So you list both the internal indicators and the external indicators. Part B of the question. Number 1. On 1st of January 2009, the government purchased a software license for $350,000 for its application in its mainframe computer. So the cost was $350,000. The government estimated that the useful life of the software would be 8 years and that it would receive benefits and the service potential from the software on a certain basis of the useful life of the software. As at that 1st December 2013, that's after how many years? That's after how many years? Use your fingers. 5 or 4? That's 5 years. Now let's determine the depreciation. So we are assessing after 5 years, 50,000. How much is the expected economic life? 8, so that you get depreciation per annum, and then we are assessing after 5 years. So how much is the accumulated depreciation? 280? 750. So how much will be the carrying amount? That 250. So that was that 250. And to that, as at that 1st December 2013, the usage of the application had declined to 15% of its originally anticipated demand. A license for a software application to replace, that's the replacement cost, to replace the remaining service potential of the existing software application would cost 150. So the replacement cost is 150. Then you deduct depreciation, assuming the same terms here. That means you take replacement of 150. You assume economic life of 8 years. You assume you are assessing also after 5 years. What do you get? 93,750. So that means the recoverable amount be an amount of 56,250. Call it B. Now give me the impairment loss. A minus B, that is 75,000. Required. Impairment loss to be recognized for the software using the depreciated replacement cost approach. Good. Can you copy that? Azungu. Kazi difficult? Oh, So also copy this format for the second method before I discuss it. Then you open June 2012, question 5B. June 2012, question 5B. June 2012, question 5B. Yeah, now this method is under restoration cost approach, whereby, now in this case, we want to replace an asset, but for you to replace that asset, you have to repair first. So you also factor in the restoration or the repair cost. And that's what about this method. So question 5, June 2012, question 5B. Let's start with 5A. With reference to IPSAS 21, impairment of non-cash generating assets, explain the following terms. 1, government business enterprise, GBE. Number 2, carrying amount. What is carrying amount? Is the amount shown in the financial statement? Good. Number 3, recoverable service amount. Good. Is the higher of the fair value less cost to sell and the value in use. Number B of the question. On 1st of January 2006, Matopeni Primary School acquired a bus at a cost of 6 million to enable students from a nearby village to commute to school free of charge. So they purchased a bus at a cost of 6 million. The school estimated that the bus had a useful life of 10 years. On that 1st December 2010, that's after how many years? That's after 5 years? 5 years. So let's determine the depreciation. So the cost was 6. The expected economic life was 10. Then we're evaluating at 5 years, you'll get 3. So that means at the date of assessment, the carrying amount was 3. On that 1st of December 2010, the bus sustained damage in road accident, requiring 1.2 million to be restored to a usable condition. So we need to repair. The restoration did not affect the useful life of the asset. The cost of a new bus, that means in case we are to replace, that's what we call now the replacement cost. The cost of a new bus to deliver similar services was 7.5 million as at that 1st of December 2010. Yeah, the replacement cost, we have to get a new bus, it will cost 7.5. Then we have depreciation. And we say that when deducting the depreciation, you assume the same economic life and then the same period. So of this 7.5 to get depreciation, you take 7.5, you divide by 10. The estimated economic life will be 10, and then you assume you're assessing after 5 years. So should be the same as what you did here. You get 3.75. So what you get here now is what now we call depreciated replacement cost, since you have to incur an additional cost to repair the asset. of which you get an amount of 3.75. But you cannot recover this because you have to replace the asset first. How much was the replacement cost? I mean, repair cost. You need to repair at 1.2. So the maximum you can recover is how much? The recoverable amount. 2.4? 2.55, eh? Good. Then you get the impairment loss. A minus B. You get 0.45 required. Evaluate the impairment loss attributable to the bus using requirement of IPSAS 21 impairment of non-cash generating asset using restoration cost approach. We do another question. December 2014. Question 5B. December 2014. Question 5B, part 2. Question 5B, part 2 of the question. Part 2, I told that on 1st of January 2004, the government built an office at a cost of 50 million. So the cost of the office was 50 million. The building was expected to provide service for 40 years. On that 1st December 2013, after 10 years of use, so first of all, it has depreciation. So it's 50. The estimated economic life was 40 years. Then we are assessing after 10 years. 12 point. So that means how much is the carrying amount? That's 7.5. Got it. Yeah. On that 1st December 2013, after 10 years of use, a fire caused severe structural damage, and due to safety reasons, the office building was closed for repair that cost that 5.5 million. We need to repair it. This repair were made to restore the office building to occupiable condition. The current cost of a new office building is 100. A new one. That means in case we have to replace. So that's the replacement cost. It will cost an hammer. How much? Then you raise depreciation, assuming the same economic life. So it's 100 over 40 times 10. Get 25. So that means the depreciated replacement cost will be 70. But for you to recover 75, you must incur the repair cost. How much is it? 35.5. So how much will be the recoverable amount? That 9.5. Now give me the impairment loss. You get an amount of? You get 0. Have you ever seen a negative, which is an impairment? We say that an asset is said to be impaired when the carrying amount exceeds the recoverable amount. How much is our carrying amount? That's 7.5. How much can we recover? That 9.5. Do you have impairment? No, the asset has not been impaired. So there was no, you see what we are doing? We are assessing for impairment test. The asset was not impaired. Actually, these two, that difference of 2 should be a revaluation reserve required. Impairment loss to be recognized for the office building using the cost restoration approach. And impairment loss will be 0. Good. So we can copy. We can call it a day.